So I want to talk a little bit about insurance. I mean, could be easily a whole show dedicated to how insurance works, how insurance companies make money, how it's funded. But how does insurance work ideally? What is the way insurance works? Insurance is something where, I mean, think about auto insurance. Insurance companies look at you and the car that you have. You're insuring against accidents. So they look at your past driving record. They look at how many tickets you have. They might not sell you insurance because you might be too high of a risk. They look at the value of your car, how much it would cost to fix it if something bad happened. And, you know, they make an assessment of, okay, we assess that the probability that you'll get into an accident is X, and we assess that the size of the payout if he gets into an accident will be Y, and we need you to pay in something of greater value, greater than the probability times the assumed damage. And of course, some people will cause more damage more frequently, and some people will cause less damage less frequently. And the insurance company just has to be right on average. And what they do is you pay in your insurance premium on a monthly basis. And funnily enough, if you suddenly stop paying your premium and you have an accident, the insurance company will not pay you. Right? Your coverage is only current as long as you pay in. And indeed, your goal in life should be to pay insurance and never collect. Like, you never want a fire in your home. You want to pay fire insurance, but never collect because there's never a fire. You want to buy auto insurance and never collect because you're never in an accident. You want to buy life insurance. Like, I have life insurance. I bought this life insurance, $1 million for 20. It covered me for 20 years, and I paid a lot of money every year. And then at the end of 20 years, the insurance just went away. It just went away. And I didn't get a dime. I gave the insurance company huge amounts of money. Never got anything in return. Nothing. It's ridiculous. Insurance is a scam, obviously. Now, what did I get in return? What's the value I got in return for paying the premiums? The value I got was peace of mind. Peace of mind. The value I got was risk management. Was the knowledge that if something happened to me, if I died, then my wife would at least have that $1 million. She'd lose my income, but she'd have that, right? So it's not a tangible thing that you buy with insurance. And indeed, you hope never to collect. What you're buying is risk control. You're buying is peace of mind. If something terrible happens, you're covered. And people have a really hard time understanding that. Really hard time. They want something tangible in return. They're giving the company money. They want something in return. They're not getting anything in return. They can't see what they're getting. Now, how does the insurance company make money? It collects money from you and it invests it. And the way it makes money is off of those investments. It pays out every year. It pays out a certain amount because some people die or some people have car accidents or whatever. And it brings in some money. And then it has investment income. And that's how insurance companies make money. It needs to make sure, and the money it makes is really on the investment. Hopefully the money in, money out balance each other out, and the profit is the investment income. That is the ideal. Years are going to bounce around. Some years the insurance company will lose money. There were more payouts than expected. Some years they'll make more money than expected because there were less payouts than expected. And of course, this is true of all forms of insurance. Now you say, what happens when the insurance company goes bankrupt? Well, one of the things you want to look at is as the insurance company bought insurance. So insurance companies also buy insurance to cover, the policies that they have in case that they get in trouble. It's called reinsurance. And their whole markets, insurance markets are unbelievably complex in that sense. And there's a whole science, actuarial science, that deals with the money coming in and what to expect, and the money going out, what to expect, and all of this. And it's, if you get an actuarial science degree at university, you're going to make a lot of money because it's sophisticated math, although AI probably does a lot of this, but it's sophisticated math. Not a lot of people do it. Not a lot of people know about this profession. And people who are in the profession make a really good living. And there's huge demand for it. Actuarial science. And it's a massive market out there. Insurance, reinsurance, and then insurance companies are some of the biggest investment funds in the world out there. No, reinsurance was not the 2008 crisis. All right. Now, health insurance is a little different. And the difference is that with health insurance, they are not allowed to assess your risk. Now, they can assess it somewhat by age. So depending on the age, you might pay a different premium. But they're not allowed to actually assess your risk, your health. And as a consequence, it's a messier game, if you will. It's rougher. It's more difficult. If you're healthy, you're paying a higher premium than you would otherwise pay. If you're sick, you're paying a significant lower premium than you would otherwise pay. So the way health insurance in the United States is set up, it is a way for the healthy to subsidize the sick. Pre-existing condition is just one form of that, where we now insure pre-existing conditions. So the insurance company knows you have a condition, and they still have to insure you. But the point about insurance in a free market is they would come and test you and check and see exactly what health you were in. And they would also, maybe, they would put a health tracker on you and assess how much exercise you do, how good or bad you eat, what's your metabolism like. Like, think about insurance companies who today put trackers on cars and only charge you based on how many miles you drive. But that also allows them to monitor your driving habits. Well, imagine if health insurance companies could do that on you. Now, that would provide you an incentive to behave. The incentive would be lower premiums. But that's not allowed. So health insurance companies do it all on averages. And then when you get sick, you go to the doctor prescribes something, and he has to get permission from the insurance to pay it, because what the insurance doesn't want is basically you've bought insurance, you paid them, and now they have to cover all your healthcare costs. And what they don't want is for you to abuse that. Like to overconsume healthcare, which is very, 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 very likely that you will overconsume healthcare, given that you're not paying for it. The insurance company is paying for it. And you're not paying what I'd call an accurate amount to the insurance company. You're not actually paying an amount of money to the insurance company that reflects your risks, which you know how much risk you have. So you could easily overconsume healthcare. So the insurance company has to monitor the claims. And as a consequence, it's going to not approve some of them because they worry that you're overconsuming, because the incentives are screwed up. Incentives are screwed up.